Good afternoon, my ECO 3311 students. Up to this point, we have finished chapter 9. Your second midterm exam is going to be this coming week on Friday. So make sure you start preparing for that exam starting this Monday because you don't have a lot of time. Yeah, my exams are non-cumulative. So that midterm exam is going to cover chapter 6, chapters 8, chapter 9, and this chapter 12, which I'm about to be recording on financial crisis. So there are only 4 chapters that's going to be on the exam. I'm going to upload the review sheet, just like I did for exam 1 at Canvas, sometimes on Monday tomorrow. I will also put like a couple of practice questions on those chapters to kind of give you an idea how the framework of the questions that are going to be on the test look like to help you study. So anyway, let me share my screen on this chapter 12, and then we're going to talk about it on the other side. So once we finish chapter 12, we're going to be embarking on monetary policy. So the chapters that are, any lecture recording after this chapter is going to be the material that will be on your final exam. And my goal is hopefully by the end of this week or early next week, we should be done. I should be done with all the lecture recordings that will be posted at Canvas. So all you got to do is just watch the videos, do your assignments, and then come for the exams. Okay. All right. So anyway, so let me share my screen here. So here's a chapter on the financial crisis. Okay. So let's talk about it. So the financial crisis is one of the most important topics in when we're studying the financial system, right? They have happened a lot in the United States over and over again. So we are going to be defining a financial. So this chapter is going to make use of what we call agency theory, the economic analysis of the effects of asymmetric information or adverse selection models on financial market to see why financial crises occur in the first place and why they have such devastating effects on the economy. We know one of the worst financial crises happened during 2007, 2009, which became known as a global financial crisis, but it had its roots in the United States because it originated from the US housing market. The housing market basically collapsed. That led to a great American recession, and that led to so many failures of financial firms, like many banks had to be closed down during that time. So we're then gonna apply our analysis to explain the cause of events that lead to a number of past financial crises, including the most recent global financial crisis. So what you're gonna learn with a financial crisis is that it does not happen overnight. There's gonna be some steps, some sequence of events that lead to a financial crisis. Okay, so we'll talk about those sequence of events. So the learning objective here, we're gonna define the term financial crisis here. Okay, and then after defining the term financial crisis, we're going to identify the key features of the 3 stages of a financial crisis. And then we shall also describe the causes of the consequence of the global financial crisis of 2007-2009. We shall also talk about the Great Depression. Of course, I'm going to talk a little bit about that. Then summarize the changes to financial regulation that developed in response to the financial crisis, because Congress had to pass a bill called the Dodd-Frank bill in 2010 to make sure that there's more regulation in the financial industry so that banks don't screw up again. So then we're going to identify the gaps in the current financial regulation and how they might be addressed in the future. So here's how we define financial crisis. A financial crisis is going to occur when there's a particularly large disruption to information flows in financial markets, with the result that financial institutions increase financial friction increase sharply, and financial markets are going to stop functioning. So what do I mean by this? What do we mean by is a particularly large disruption in information flows? Let me give you one example. Banks in America, for example, are highly interconnected. Okay, banks share information. So think about if a bank like Citibank were to fail. This is one of the biggest banks in America. That means all the other banks that remain and that share information with Citibank, that information is going to be gone. So there's going to be disruption in information flows. Same with companies. When a major corporation fails, that can have, it can impact information flows in the entire the companies that are remaining, all banks, financial institutions that remain, they fail to get information sharing, like they used to. So we talked a lot about that. But before I actually start talking about the steps of the financial crisis and a number of stages that lead to a financial crisis, I just want to discuss briefly what the types, which I did not list here on the PowerPoint slide. Let's talk about the types, or sometimes we call it forms of financial crisis. There are only three types of financial crisis. So let me make a list. I say three types. In my country right now, the first question I would ask them is, what type is it, or what form is it? Because there are only three main types of financial crisis. The first type of financial crisis is what we call a banking crisis. So a banking crisis is a scenario where this is where several banks go bankrupt or become insolvent and are forced to close down. That is what a banking crisis. Like going back in time during the Great Depression, where over 4,000 banks in the United States had to fail. That was like almost a whole collapse of the financial system. Okay, you go back to the Great Depression. Then in 2007, 2009, several banks failed in the United States as well. So that's a banking crisis. And I have to tell you this. We're going to talk about the other two types of financial crisis, but almost all financial crises that have happened in the United States have been some kind of banking crisis. The United States has never experienced the other two types of financial crisis that I'm about to mention. Okay, so the second type of financial crisis, if a financial crisis is not a banking crisis, if a financial crisis is not a banking crisis, it's going to be what we call a debt crisis. So a debt crisis, this is where a government fails to make principal and interest payments on the debt. Then we say that the government as well. The government is no, there's a debt crisis going on. I know some of you might argue that, well, if my government fails to make principal payments on the debt it owes, I don't care because that's government. But let me tell you one thing. You ask yourself, if this happens to you, let's say you fail to make a single payment on your credit card, what would happen to your interest rate? The banks that give you issued on that credit card, they're going to jack up your interest rate. And so all interest rates in the economy tend to move together. So if our government were to default on its debt, that means all interest rates in the economy are going to increase. Not only the interest rate on government bonds, on treasury bonds, but your mortgage rates would go up, your student loan interest rate would go up, your car loan rate would go up because interest rates move together. So that's how you're going to be affected. Even though it's a government that is defaulting, that's going to trigger increase in all interest rates in the economy. The good news is that even though the United States is the largest debtor nation, our national debt is about $36.5 trillion today. The United States has never defaulted on its debt. Okay, so that means a financial crisis that takes on the form of a debt crisis has never happened in the United States since the nation's founding. Okay, Okay, but it has happened several places. Great Britain, for example, defaulted once. Um, uh, Greece defaulted in 2008. The government of Greece defaulted. The government of Argentina defaulted in 2001, the Argentina debt crisis. Okay, and several other South American, African countries, other countries in Europe defaulted in the past. Okay, so that's what a debt crisis is. And then the last type of financial crisis, if a financial crisis is not taking the form of a banking crisis or a debt crisis, it takes the form of a currency crisis. A currency crisis. So this is when a country's currency or country's money, currency, or you can say slash money, loses almost all its value. Loses almost all its value. So the currency would become like no value at all. Okay, so there are several examples I can give here. Like in 1994-95, the Mexican peso lost all its value. So Mexico went through a serious currency crisis in 1994. And then you go back to 1920s, Germany went through a very serious currency crisis. The German Deutschmark lost almost all its value. Recent examples include in the 2000s, this country that borders South Africa, Zimbabwe, the Zimbabwean dollar lost almost all its value. Okay, we have the cases in South America, Venezuela. Venezuela's currency lost almost all its value. So there's several cases around the world, and again, the United States has been spared of this type of crisis. Even though the dollar depreciates here and there, when I'm talking about currency losing value, yes, where you wake up maybe 60% or 70% of the country's currency has been wiped out. The dollar can depreciate 5, 10%, 3% here. That is not a currency crisis. So the US dollar has never lost almost all its value. No. So that means the United States has never gone through a currency crisis in the history of the nation's founding. Neither has the United States gone through a debt crisis. The only form of crisis that have happened here in the United States have been some form of banking crisis, okay, where banks fail and they're forced to shut down their operations. Those are the only types of crises that have happened here in the United States. And the financial crisis in America used to be more prevalent before we founded the Federal Reserve System in 1913. Because before 1913, we did not have a central bank, okay? So, the role of the central bank, as we saw in our previous chapter, is to regulate all other banks in the economy. So if you don't have a central bank, then that means banks could do whatever they want. They're most likely going to make mistakes, and that could lead to their fall. Okay. So let's go and dig deeper. Now that you know the three forms of financial crisis, let's kind of dig deeper and discuss more. Okay. So I want us to start talking about the dynamics, okay, of a financial crisis. And this one, you can say this is in reference to what? To an advanced economy like the US. All right, so I want us to go through what has been happening, or you could just say the stages, or for dynamics, or you can say stages / dynamics of financial crisis to an advanced economy like the United States. So as I said in the beginning, we don't just wake up one morning and there's a financial crisis, okay? There are several events or things that lead up to that financial crisis. Then it just blows up, okay? So they're going to be like things that are going to build up through time. And then all of a sudden, the financial crisis becomes fully blown. So let's talk about the initiation of that crisis, especially in an advanced economy like the US. Let's look at stage one, where it all starts. So we're going to talk about initiation of a financial crisis. We'll talk about things like credit booms and busts, mismanagement of financial liberalization or innovation, which typically lead to asset price. But what do we mean here? So the initiation of a financial crisis can take two different forms. One, it could be banks making mistake, because when there's always a credit boom where banks are giving a lot of loans. Let's say American banks decide to give loans to so many borrowers, both prime borrowers and subprime. Prime borrowers are borrowers with very high credit ratings. Subprime borrowers are borrowers their credit ratings are not very high. Americans who don't have a lot of good credit. So that means they're credit risk. So if banks are reckless with lending, there's always a credit boom where they're lending money everywhere in the economy to everybody. That's what we saw in the early 2000s. That led to the financial crisis of 2007. They were giving out mortgage loans everywhere. So people are buying homes, like expensive homes. Even people who could not afford those homes were given loans to buy those homes because there was less regulation in the market and banks went crazy with lending. So what did we expect? A lot of Americans started to default on their mortgages, in 2007, 2008. That resulted into a very serious housing crisis in the United States. Because if you defaulted on your mortgage, the bank would put a lock on your door. They would foreclose on you. They would take away that house because you still own it. But the problem was so many of those houses became foreclosed, and the banks recovered most of them. When a bank would recover a house from a customer who failed to pay, no big deal. They would put it back on the market for sale. But the problem was many of those houses were coming to the marketplace, you know what I mean, creating more supply than demand. So the home values were not rising anymore if you have more supply of housing than demand. In fact, they went down. And that created a very interesting for second loans, you know what I mean? They didn't want us, they thought it didn't make any sense. Okay. I have one of my friends who live in California who told me that he bought a house for $300,000 in some rural part of California. But in the height of the financial crisis, his house was only worth $90,000. And yet he still owe about $300,000 on that house. So that is credit boom, what credit boom and bust can lead to. But there's also another dynamic, like mismanagement of financial liberalization and innovation. So Wall Street is always innovating. The financial industry is always innovating. We're always coming up with new financial products. Some innovation could be more like the development of new physical infrastructure, like in 1973, when we discovered the ATM machine. The automatic teller machine was discovered in 1973. Now that means before 1973, nobody around the world or in the United States in particular use a debit card. Because debit cards that you guys have today, MasterCard and Visa cards, was created as a result of the ATM machine. So before 1973, there were no ATM machines. If you wanted to withdraw cash, just $100, it required your physical presence at your bank location. So it was so primitive and so inconveniencing. Sometimes someone could be living like 60 miles away from their next bank location. Okay, so you had to drive 60 miles, go back and forth to withdraw just $100. Very inconvenient when you think about it. But then somebody invented an ATM machine. That was a very good invention. But some innovations are not physical innovation. Sometimes Wall Street, they are basically innovating and coming up with new financial products. Like we're going to talk about what they did in the early 2000s when they came up with this fancy concept called securitization, which involves basically bundling of residential mortgage loans, and creating new financial products where they would sell shares in them. Okay, so that was the beginning of the mortgage-backed securities, the collateralized debt obligation and credit default swaps, which I'm going to be talking about shortly. Okay. And those new products were not being regulated by the government on a consistency basis. So Wall Street kind of mismanaged those new financial products, and they ended up in what? In trouble. Okay, we'll talk about that in a short while. So those liberalization innovations sometimes lead to asset price booms and bust. Okay, where the values of assets like housing or stock, they're gonna go up, increase exponentially, and then eventually they bust. Bust basically means that they stop increasing, but in fact they start plummeting. Values of assets start declining after a significant boom. So, and once things start to fall apart, then that can lead to uncertainty. Okay. So before no, so yeah, so that's what we So and then okay, so now the thing about it, banks are for the ones who are doing this credit boom and bust, who make mistakes. Banks on Wall Street are the ones that are innovating, that coming up with these new financial products. And if we don't regulate them properly, sometimes they can mismanage those financial products. And if they do mismanage them, or they give credit, bad credit, sometimes customers don't pay back, then banks are gonna go, they're gonna write off some of those loans from their balance sheets. That means banks are gonna be having some serious financial problems on their balance sheet, and some are gonna be forced to close down. Okay. So once banks start having crises, that's going to lead to the second stage, what we call a banking crisis. Because some banks that screwed up and gave out bad credit to Americans with very low credit ratings, if they don't get paid back, they're going to suffer huge losses on their asset side. If you don't have enough capital on the right-hand side of your balance sheet to cover those losses, that means you're forced to close down. That's exactly what we saw in in 2007, 2008. Okay, financial crisis. It was one of the deepest financial crises, maybe closer to the Great Depression. Okay. All right. So let's talk a little bit more about that. So the other thing is, once banks start to experience like a banking crisis basically means that a lot of banks are going to go out of business. Banks are going to start closing down. And think about that. If banks start closing down, that means the few banks that remain are going to tighten their lending standard. Banks, the remaining banks might refuse to lend to American companies. So if corporations can't get any loans, or Americans themselves, households can't get any loan, like individual loans, that is going to have a broader impact on the economy, on the real economy. So if we start experiencing a banking crisis, this is going to lead to what we call, it's going to lead to economic activity is going to decline. It could lead to a recession. Economic activity declines. And once, there's a typical characteristic of a decline in economy. Anytime you have a recession, decline in economic activity, that is always going to trigger what we call, it triggers an unexpected decline in price level, in the general price level, what we call deflation. So deflation is the opposite of inflation, because when economic activity slows down as a result of the banking crisis, we're in a recession, prices tend to go down. So some of you might think that inflation is the only evil that we economists care about. Deflation can be equally worse. What do we mean? How can deflation affect Americans more, sometimes even more than inflation? Okay, so think about it. Deflation is going to affect people who are borrowed funds, because it raises the real value of the debt that you owe. If you borrowed, like, say, $100 today, and let's say I'm just going to give you a simple example to show you how debt deflation or the deflation can affect the value of your debt. And that's what we're calling a debt deflation. So let's say you went to the bank today and borrowed $100. That means the real value of the purchasing power, and you borrowed $100. It is as if the bank has lent you 10 lunches, because each lunch costs $10. So if you have $100 divided by 10, you get 10 lunches. So let's say you are scheduled to pay back this loan next year. And let's assume that next year, when you have to pay back this loan, this $100 loan, and by the way, with interest, what about if the price of lunch has decreased from $10 to $5? Because that's what we call a deflation. Deflation is when prices are going down in the economy. So that means next year when you have to pay the bank, what is the value of $100 in terms of lunches tomorrow if lunch drops to $5? That means it basically means that you are going to be paying back 20 lunches to the bank because $100 you're paying back tomorrow can buy up to 20 lunches. That's not fair to you as a borrower because when the bank lent you money today, $100, it could only buy you 10 lunches. Now you have to pay back $100, which is more valued, more valuable in terms of what it can buy you. That's what we call it. So anytime there's a deflation, prices are going down, it raises the purchasing power of the debt. Okay? That's what we call a debt deflation. So most Americans actually go bankrupt because they're looking at, oh, and now I have to pay a much higher value dollar than somebody paid back, gave me. So that's what we call a debt deflation. It can be very dangerous. Okay. So let's go on. I'm gonna represent this in a kind of in a diagram, the stages that I talked about. So here's the stages like we talked about the deterioration in the financial initially because deterioration in financial institution balance sheet. This is where we're talking about banks that giving out bad loan, credit booms and bust. Okay, and then customers don't pay back. That's gonna affect their balance sheet. Or it could come straight up from, and then asset prices are going to decline because once banks start having problems, then asset prices go down, like housing prices are going down, and that's going to increase uncertainty. So that leads to adverse selection and moral hazard in the debt market and even in the what? In the equity market. Okay. But, so now because if people start to decline making payments on their loans, then banks are going to tighten their lending standard. That's going to lead to adverse selection because in adverse selection, one of the scenario where banks could tighten lending standard and refuse to lend in the first place. So that is going to lead to the second stage, which is a banking crisis. With a banking crisis, economic activity is going to decline. And if the economy enters a recession because of that, because some banks had failed and the few banks tighten lending standard leading to a recession, that means even more Americans are going to be laid off from their jobs. There's going to be high unemployment. That means some companies are going to shut down. Okay. So that is going to trigger even more banking crisis and more other economic activity declining. So once we are now in a serious recession, then we go to stage 3, which we are calling the debt deflationary cycle, where because one of the key characteristics of a recession is that prices tend to what? Prices tend to fall. That's what we call unanticipated decline in price level. That leads to this debt deflationary cycle that I'm talking about, that, individuals who are in debt even are more into debt in real terms, in real purchasing power, because now they have to pay back a value of the dollar that they borrowed, which is now worth more than what they were given in the first place. So some people just go without paying back, and then the debt crisis is even gonna deepen, and that's can actually make economic activity even decline further. So those are kind of the stages of the financial crisis, how they can spiral out of control. But once you reach stage 3, that is like a worst possible stage because that's like where the financial crisis become fully blown. So those are some of the stages of the financial crisis, from initiation, from asset price decline, when banks make bad credit, they make bad loans, or the financial innovations that are lead to a creation of new financial products that are unregulated and banks messed up. Okay, so let's talk about there's some case studies here. I'm going to start with some of the case, what happened. Let's start the mother of all financial crisis, the Great Depression. So you guys learned from your history books that the Great Depression was one of the key economic downturn that affected the global economy. Okay, the United States was severely impacted by the Great Depression and the rest of the world in general. So how did the financial crisis unfold during the Great Depression era, and how did it lead to the worst economic downturn in U.S. history? Okay, so the Great Depression, first of all, happened from 19. Let me go back here. The Great Depression happened between 1929 to 1933. One of the longest economic downturn in the history of the U.S. Who was president in the United States? This was under the Hoover era, the Herbert Hoover was the president of the United States. So it was so deep that the deepest recession to ever happen here, the unemployment in the United States peaked at 25%. In other words, 1 in 4 Americans was unemployed. And that lasted for nearly 4 years. The Great Depression, to be precise, the Great Depression lasted for 43 months, which was close to what? 48 months to be 4 years. So what does that mean? That means on average, if an American were to lose a job during the Great Depression, it would take them nearly 43 or nearly 4 years before you could get your next job. That is unheard of in contemporary times. Okay? Because we know that today when somebody loses a job, some people take only 2 weeks, 1 month, 2 months they find a new job. But on average, an American were to lose a job during the Great Depression, it would take them nearly 43 or nearly 4 years before they could find their next job. That was deep. Okay? In Great Britain, the Great Depression was even worse. The unemployment in Great Britain peaked at 27%. The Great Depression was so bad that most European nations started to lose faith in the working of the free market, in capitalism. Okay? To an extent that some countries actually wanted a complete government takeovers of their economies because they started not to believe in the power of the free market. Okay? So, but let's discuss with the event, some of the things that happened here in America during the Great Depression, just briefly. So the event was brought by the stock market crashed down. I'm going to show you how it crashed. Okay? The stock market crashed so badly that 90% of the stock market valuation on the Dow Jones and other stock market index that we follow were wiped out. When I say 90% of the stock market value was wiped out, what does that translate in actual dollars? Okay, it's like saying you had $1 million in the stock market and you just lost 900,000. You're only worth $100,000. Or if you had invested $10,000, you just lost $9,000. Your money only remaining so about $1,000. That's how bad it was. Okay, and that led to the close of so many financial firms. That also led to the what? Bank panics. So banks started to close down. So what are bank panics? Bank panics, or you can call it what? Bank runs. You also call it bank runs. It's where people become nervous and rush to withdraw all their monies from the banks. Why did it happen so rapidly that Americans went and withdrew most of their money from their banks? Let me tell you one thing. If all of us show up at our bank location one day, all Americans show up at their location and corporations that have deposited money, billions of dollars in these banks, and we show up and say, okay, we want our money out. We want to withdraw all our money on a single day. The banks would fail. Banks depend so much on customer deposit. So it was so worse during the Great Depression because we did not have the FDIC. What is the FDIC again? So during the Great Depression here, this period, there was no FDIC. FDIC stands for Federal Deposit Insurance Corporation. Let me say that again. FDIC stands for the Federal Deposit Insurance Corporation. Okay, so between 1929 to 1933, the United States had no FDIC. What's the main primary function of the Federal Deposit Insurance Corporation? It means that when you deposit your money in a bank, okay, your money is insured by the federal government, up to $250,000 on individual account. Okay, we did not have that. There was no FDIC between 1920 and 1933. The FDIC was created when FDR, Franklin Delano Roosevelt became president of the United States in 1934. Okay, after Hoover. How about Hoover was a one-term president? Maybe the Great Depression made him a one-term president. So in 1934, FDR became president of the United States, Franklin Delano Roosevelt. So when Roosevelt came into power in 1934, the first thing that he did was to ensure that they created the what? The FDIC. Okay. So what did that mean during the Great Depression 1920, 1930? So because there was no FDIC, meaning that if you had your money in a bank and a bank were to fail, you lose all your deposit. So now, the reason why people had a run on their bank or bank panic started was because even if a bank were to close in my neighborhood, my interpretation would be that my bank was next. So what did I do? I would rush to try to withdraw all my money before my bank closes down. Not all Americans were acting the same way. And that led to like over 4,000 banks in the United States closing down. It was almost a total collapse of the financial system. Okay. All right. So anyway, so since many banks were closed down, that led to the decline in stock market prices, and that led to the debt deflation because it triggered a very serious recession, which became known as a Great Depression. Okay. So here's what the stock market, I was telling you, how the stock market declined during the Great Depression, during the Hoover era when the Great Depression started. You can see if you had a stock market was at its value of about 100%. And then the Great Depression hit, look at how the stock, 90% of the stock value, it was wiped out. See, you're down to 10% here. That's exactly what I was telling you. So on average, that meant if you had about $1 million in the stock market, you just lost $900,000. If you had $10,000, you just lost $9,000. So after the Great Depression ended, then you can see the stock market started to recover during the what? During the FDR regime. Okay. This is another way of measuring credit risk during Great Depression. Is what we call the credit spread. The credit spread basically measures the difference in interest rate that is paid to a bond with zero default risk, which is a U.S. Treasury bond, and a corporate bond, which is rated triple B. Because if a bond is rated triple B, that means it has got some significant default risk. Remember from our previous chapter, the higher the what? The higher the riskiness of a bond, the higher is the interest rate that should be paid on that bond. If a bond has got no risk, like the U.S. Treasury bond, zero default risk, because the United States government has never defaulted on its debt, that makes a U.S. Treasury bond the safest bet. So that means U.S. Treasury bonds have got the lowest interest rate. So let's say if the interest rate on a U.S. Treasury bond was 2% at the beginning of the Great Depression, and the interest rate, like say on a bond, a corporate bond, which is rated triple B, is 4%. So the difference in this interest rate is what we call the what? The credit spread. Okay. So it was 2% at the beginning of the Great Depression in 1929. Look at how that credit spread went up. It went up to nearly 7, 8%. That means because when the economy is falling apart, corporate bonds even become more and more riskier, meaning that the interest rate on corporate bonds are going to rise disproportionately more than what? Any change in the interest rate on treasury bond, which is a default risk-free bond. So that's going to widen the credit spread, okay? But after the Great Depression ended, you can see that credit spread kind of fell back to its pre-shock average, okay? So that's exactly what happened during the Great Depression. Okay, so what about the recent global financial crisis, which was still deep in 2007, 2009? How did that unfold? So I want to start from the beginning because I want to make sure that you understand this very well. I want to discuss the concept of securitization here. Okay, as I told you at the beginning, Wall Street is always innovating. Okay, meaning that Wall Street is always coming up with new financial products. So in the early 2000, Wall Street came up with this fancy concept. Okay, I'm gonna talk about the concept of securitization. Securitization. Okay, that is an innovation in what? An innovation in the early what? In the early 2000s. Okay, where banks would give several mortgage loans, and turn around and bundle those loans and create new financial products, create new financial products where they would sell shares, where they sell shares. That's securitization. So I'm gonna talk about how it happened. So this is a process of securitization. So the banks were giving loans to risky borrowers. In a normal qualification for a mortgage process in the United States, if you want to buy, your family wants to buy a house, you go through the mortgage qualification process. That means your family has to save for a down payment. Okay, then the banks are going to run your family's credit scores to ensure that the family has got consistent income to actually be able to make payments on that loan. Okay, they look at your credit. But because the process of securitization ensures that banks need to have so many mortgages. So in the early 2000s, almost every American who had qualified for a mortgage through the right qualification process already had a mortgage, they already bought a house. But because banks had created these new financial products, they needed more home buyers. They started adding some risk that involved no proof of income, no documents, and that's what they did. So instead of lending to what we call prime borrowers, they started lending to what we call subprime borrowers. Subprime borrowers, these are borrowers with very low credit ratings. Borrowers with low credit rating. But these are borrowers with high credit rating. Borrowers with high credit ratings. Meaning the banks started to add risk. So what the banks did, they would give these loans, mortgage loans, to both prime borrowers and subprime borrowers, and they would package them. Okay, let me show you the process of packaging here and create new financial products out of them. Let me show you this. This is exciting though, what they did. It was an innovation. So they give these mortgage loans and then they would package them like this, okay? Because the bank has given loans to different credit risk groups. So if they loan money to Americans with the highest credit rating, those are safe loans. They would bundle those safe loans and sell shares to investors who want to invest in those in those assets. So they basically call these, okay, they're going to call these, they created what we call the mortgage-backed securities, which are new financial products that investors could buy shares in. So what they would do, they would give this mortgage and they would strip them into like 3 layers of cascading trays. So if they gave a bunch of mortgage loans to, like, say, Americans with very top credit ratings, they're gonna bundle those mortgages and then sell shares to investors who want to invest in all in safe assets. So this is gonna be what they call safe. And then they will also give some mortgage loans to Americans whose credit rating are somewhere in the middle. They're neither great credit rating nor bad credit rating. And then they also package those loans and sell shares in them to investors who only want who want okay investments. So they call this okay investment. And then the last slice here, these are now subprime mortgage. They give mortgage loans to Americans who should not have been given these loans in the first place because the government was not regulating the market. Okay, so they call this risky, and they only sell these shares to bundle this and sell shares to investors who want to invest only in risky assets like what? Like hedge funds. So the stripping of these mortgage loans into these three cascaded trades, this thing is, they called all these strips, they call this a CDO. CDO is what we call, is the same thing as collateralized debt obligation. That's what I see you. So let me write here. So CDO stand for collateralized debt obligation. Okay. Now to make sure that, because some investors are really picky, to ensure that investors, because investors who want to invest in the safe slice here, they are really picky investors because they only sell this to safe investors. They are investors who are really risk averse. Risk averse means you hate risk, of course. So to ensure that these securities that they're selling to safe investors are even much safer, the banks would insure these top slice for a small fee called the credit default swaps. So the top slice is going to be insured for a small fee called the credit default swaps, or CDS. Okay, and companies like American Insurance Group, AIG, were the insurance companies who are providing this insurance against those securities. Meaning that if I invested in those securities and maybe somehow it loses value, I would get compensated somehow because it's insured. Okay, so that's the whole essence. Now the problem was, the idea here is that once you pack these securities like this, some of them are risky, some of them are okay, I said. So let's say some, because we call this a mortgage-backed securities, all these like CDOs and CDS, because it's based upon Americans making payments on their mortgages. Because the banks are giving mortgages and then bundling those mortgage loans and selling shares in them. Meaning that if some borrowers were to default, money may not flow dripping every month. So this downslice here might be in trouble because those people who are defaulting are basically risky borrowers. Okay, so that's what they did. But so the financial innovations emerged in the mortgage markets, just like I explained. Instead of banks lending to prime mortgage borrowers, they started lending to subprime mortgages. And they came out with those financial instruments like the mortgage-backed securities. I talked about it, where they're going to bundle residential mortgages and stripping and selling shares. So the strip-up version, where they strip them into like three cascaded levels, is what we call the CDO, the collateralized debt obligation, the CDOs. Okay, and then they would insure the top slice and call it a what? A credit default swaps. Not surprisingly, Americans started defaulting on their mortgages in 2007. You see, the key idea about what the banks did, they were banking on on the premise of insurance. That says that if you're an insurance company and you insure, let's say 1,000 risky, let's say you're a car insurance company and you insure 1,000 risky drivers. The belief is that not all those 1,000 risky teenagers you have given them car insurance are going to get involved in an accident on a single day. So guess what? If an insurance company insures 1,000 risky teens who are driving expensive vehicles, BMW, Lamborghinis, okay, the idea is that they better not be involved in an accident on a single day. Guess what? They actually did. In 2007, all 2006, 2007, Americans who were taking on those risky mortgages started defaulting, and they were all defaulting at the same time. That was the beginning of the housing meltdown in the United States. Because banks which are who had given these loans, they would see like a wiped out on their balance sheet. Mortgage, when people default, that means that becomes a bad loan. You have to write it off your balance sheet. And that led to so many financial firms in the United States going bankrupt because of this. Okay. So So this what we call one of the problems was the problem is that's what we call is an agency problem, which we call originate to distribute model. Is always subject to a principal agent problem. So the mortgage broker because the mortgage broker they earn a lot of commission. The more houses you sell, the more homeowners you find, potential home buyers you find, that means you're going to make a lot of money in commission. They are no interest in scrutinizing, telling the lender or the investors that the mortgages, the persons they were approving for these loans, or the potential buyers who are supposed to buy these homes were credit risk, because they knew that if they declared that, then they would not make their commission, because the more homes you sell, the more commission you get. So there was a little bit of a principal agent problem that there was a trust between lack of trust between investors and the mortgage brokers. Lack of information flow between those two. So the investors who were investing in this new financial product, the mortgage-backed securities, were banking on the general idea that when mortgages were getting approved, getting originated from the broker level, those mortgages were relatively safe. So that when banks would give out those loans and package those mortgages and sell shares to investors, there would be some kind of good investment, safe investment. But it turned out not to be true. There was a lot of risk in those mortgage-backed securities that I talked about. And borrowers themselves had little incentive to disclose information about their ability to pay back the loans. So commercial and investment banks, as well as rating agencies, had weak incentives to assess the quality of securities, those mortgage-backed securities. Okay, so asymmetric information crept up in the housing market, and the credit rating agencies, were really, they had conflict of interest. Okay, and that led to the surge, what they call the housing. So what was happening in America at the very beginning, in the early 2000s? Let me show you. There was a bubble in the housing market, and then the bubble burst. So if you look at if I put home values in the United States here, like medium home values versus time. In the early 2000s, like 2001, 2003, home values were rising in America practically forever. But then it reached around 2007. They stopped rising, 2007. In fact, they plummeted. So this is what we are calling what? This unexpected increase in the home values is what we call a bubble. But then the bubble burst. So a bubble is basically an unrealistic. Okay, let me talk about what it is. What do we mean? We say there's an asset price bubble, or the bubble in the values of homes. A bubble can occur in a stock market, and a particular value of stock can rise unexpectedly. So a bubble is defined as an unexpected increase in the value of an asset which do not reflect their true value. It was crazy around that time. That was a time when in 2003, 2002, I was doing my master's. I live in the Dallas-Fort Worth area. I would see, like, someone would buy a house for, like, say, $400,000. Before they barely even move into the house price would have gone up to $430,000. So you could literally see that something was wrong. This unrealistic increase in the value of an asset there was something going wrong in there. Okay, I remember I asked one of my professors, and I asked him, I told my professor that this seems unreal. And then he told me to shut up. But after a few years later, when the bubble burst, and I gave him a call, I said, hey, buddy, how are you doing down there? Okay, because I really saw that there was something wrong. So there are two causes of a bubble here. Let's discuss this. What makes the value of an asset go up unexpectedly, and which do not reflect their true value? So two causes of a bubble. One, a bubble can be caused by what we call irrational exuberance of the investors. Irrational exuberance of the investors. So what do we mean by this? This is basically mean that the idea that investors tend to have while unrealistic beliefs about the future value of an asset. It happens even in the stock market. So so sometimes it's kind of driven by human psychology, rational exuberance. Okay, so if let's say I start to think about that, oh, if I buy this asset, I'm gonna get rich. Maybe it's gonna go up by 80% in the next 6 months or 5 months. Then I'm gonna sell it. So that's how people were thinking about housing. Americans were buying houses not because they wanted to live in those homes, but the general belief that they would buy and live in there for a short while, then they would flip it and sell it for a double or triple the price. So if all of us act that way, where we all have this unrealistic wild expectation about future increase in the value of an asset like a house or even a stock, the demand for that product is going to go up. That's going to drive up the prices anyway. So that's one of the causes of the what of that housing bubble was irrational exuberance. The problem with irrational exuberance is that it's very difficult to identify that in the data because it's based on human psychology. You cannot go deep into everybody's mindset to kind of like extrapolate and find out what they're really thinking psychological about the future value of an asset. That's very difficult to identify in the data. But the second bubble, which can be easily identified in the data, is what we call, which was also happening in the early 2000s. So if a bubble is not going to be driven by rational exuberance, it's going to be driven by what we call credit booms. So credit booms lead to what we call credit-driven bubbles. What do I mean by this? Anytime banks become reckless giving money, loaning money to an industry like housing, like what we saw in the early 2000s that I already described earlier, banks were dishing out loans at very low interest rates, right, to Americans. So, and anytime interest rates fall very low, even if somebody was not ready to buy a house, they're going to be motivated. Okay, maybe I should start applying for a loan. And if banks are reckless giving these loans, they're going to be giving so many credit because interest rates are low, people want to borrow to buy homes. That is going to lead to a bubble. If banks make kind of like eases its way in approving loans, then that's going to lead to credit-driven bubbles. Economists, this type of bubble is very easy to identify in the data because all you got to do is look at just look at the trend of credit. You see it in an industry like housing. If you look at trend in mortgage loans, if they're exploding, that you could basically isolate that growth in mortgage rates or mortgage growth and try to kind of like compare with how the value of the houses are rising, because that's going to put an upward trajectory on what? On the demand and price of what? Of an asset like housing. Okay, so those are some. So there was a bubble that which eventually burst. Okay. Okay, so I talked about the collateralized debt obligation. So the creation of a collateralized debt obligation involves a corporate entity called like a special purpose vehicle, SPV, that buys a collection of assets such as corporate bonds and loans, commercial real estate loans, and mortgage-backed securities. So the SPV separates the payment streams, cash flows for these assets into buckets that are referred to as tranches that I described earlier. Remember I talked about those tranches from these CDOs? We call this, you can call alternative as an SPV, a special purpose vehicle, or a CDO, collateralized debt obligations, where they package these mortgages and sell the safe assets, safe part of it to investors who want safe investment. They sell us okay slice, and banks would invite the credit rating agencies to rate these bonds. So the bonds that are which are basically safe, they will rate them triple A rated bonds. And then part of the mortgage-backed securities, which are going to be sold to okay investors, they will rate it maybe triple B. And they didn't bother to rate the risky slides. Those ones are left unrated because they were really risky. And they would sell them to hedge funds, another risk, some other risk takers. Okay. See, I talk about the highest rated tranches referred to as the superior senior are the ones that are paid off first and so have the least risk. The lowest tranche of the CDO is equity tranche, and this is the first set of cash flows that are not paid if the underlying assets go into default. So if homeowners do not make payments on their mortgages, that means less money is gonna drip in. Then this lowest tranche is the one that's gonna suffer. So investors who have invested in those risky assets may lose out, may not get paid. Okay. So what are the effects of this 2007 financial crisis that started in the housing market? And by the way, the crisis began, even though it started in the United States housing, it soon became known as a global financial crisis. Why? Because of globalization, most of the US banks who were engaged in giving out these loans, who suffered and losses on their balance sheet, and some of them went out of business, they're tied to the global financial system. Bank of America doesn't only have branches in the United States. There are branches in Europe and elsewhere, and maybe in Asia, some subsidiaries of it. Citibank is a US bank, but Citibank has got almost branches in all countries in the world. So if a branches of Citi in the United States are being affected because they gave this bad credit on the US housing, that's going to affect Citibank all over the place. So it became a global financial crisis. So after a sustained boom, housing prices began a long decline in 2006, 2007. The decline in housing prices contributed to a rise in defaults on mortgages and deterioration in balance sheet of financial institutions. This development, in turn, caused a run on the shadow banking system. Okay? Shadow banking system, these are banks that these are more like investment banks, like venture capitalism, like, hedge funds, mutual funds, pension funds. So even not only the regular commercial banks were affected, but also investment banks were affected. And then the credit spread spread globally, the sign of the globalization financial market, right? Because it became a global financial crisis. So what they call a TED spread, which is a 3-month interest rate on the euro dollar minus a 3-month treasury bill rates. That increased substantially, like kind of similar to the credit, what I talked about earlier on, the credit spread that I talked about during the Great Depression. This one increased by 200 basis points, from 40 basis points, 0.4 to about 2.4. That's huge when you think about it. And then after that, deterioration of financial institution balance sheet, write-downs in bank assets, sale of assets and credit restriction, and then high-profile firms and investment banks started going under on Wall Street. One of the largest investment bank on Wall Street, Bear Stearns, went bankrupt in March 2008. They were forced to sell their assets for a third of its value to JP Morgan Chase. Fannie Mae and Freddie Mac, these are the two housing financial institutions in Washington, D.C. They loan money to in the mortgage industry. They also went bankrupt in July 2008. The government had to bail them out. It was so bad in 2008 towards when I remember when President George W. Bush was about to leave office in 2008. You could easily tell George Bush was just like wanted to get out of there, because with the economy was losing nearly 800,000 jobs a month. Every day you wake up on news like, and some major banks had shut down, the government bailed. So it reached a point where the government and the Federal Reserve kind of like got tired bailing banks and they let some go under. They let some banks just collapse without bailing them out. One of those banks that collapsed, the government led to let it go, was Lehman Brothers, one of the biggest investment banks on Wall Street. Merrill Lynch is basically the investment portfolio of Bank of America. They got some bailout funds. AIG, remember, they were insuring these safe assets called the credit default swaps. They also went bankrupt because if everybody defaults, that means insurance companies are going to be affected, like AIG, American Insurance Group. Okay. Washington Mutual, which is one of the biggest mutual funds in the United States, went bankrupt in 2008. They were forced to sell their assets to JP Morgan Chase was I would argue that was a bank that was very solvent, was very solid. They had a lot of money. They were buying the banks that were collapsing on Wall Street for cheap. Okay. And then the bailout package started because the economy was collapsing, because when banks fail, that triggered a recession that led to even other non-financial firms. It triggered even the collapse of the housing, not the housing, the auto industry. Because when we went to a serious recession, nobody was buying cars. So companies like GM, Chrysler, Ford, they all went bankrupt. Government had to bail all those non-financial firms as well. It was a mess. Okay, so when President George Bush was about to leave office, the House of Representatives voted $700 billion rescue or package relief to basically bail out banks, bail out the auto industry and others. So bailout funds everywhere. That bill passed on October 3rd, 2008, just a month before the presidential election. And then when President Obama was elected into office, when he just came to office on February 3rd, 2009, when President Obama was just 1 month into the office, Congress again approved another $787 billion economic stimulus. So you anything about it, 700 plus 787, that's about $1.5 trillion already. That was the only money that Congress was approving. The Federal Reserve was also using the federal, like bailing banks by providing liquidity, buying toxic assets. In fact, the Fed spent more than Congress. The Fed spent nearly $4 trillion to bail out banks, like injecting liquidity in American banks, the Federal Reserve System, the Central Bank of the United States. So while some of these bailouts were taking place from the congressional side, from US Congress, the Federal Reserve, which is a central bank, was also providing stimulus to American banks. Okay. I showed you this already. This is how the housing market collapsed in America during that time. We had a bubble, and that bubble burst around 2006, 2007. Then the housing values just collapsed. Okay. We talk about the spread, the stock price and financial. So the stock market also collapsed. This is a Dow Jones Industrial. Okay. But the collapse of the stock market was not as deep as the collapse of the stock market during the Great Depression. Remember, during the Great Depression, the stock market was at this peak. For the recent financial crisis of 2007, the stock market was at its peak, but it only lost about 50% of its value because it fell up to around 50%. The Great Depression, remember, it fell up to 10% of it. The stock, 90% of the stock market value was wiped out. So this was severe, but not as severe as the Great Depression. So then there were debates inside the Fed. Some people were arguing it was the Fed to blame for this. Okay, there's some economists who are arguing that because remember, this crisis started building up in early 2000. So one of the things that happened in early 2000 was that we had terrorist attack on U.S. soil on September 11th, 2001, terrorist activity on U.S. soil. And briefly after that 9/11 attack, the economy went to some brief recession during the Bush administration. Okay. And that prompted the Federal Reserve to lower interest rates significantly to only like 1% to keep the economy strong. So some economists are arguing that because the Fed, again, overstepped in and made the interest rate super low, that was what triggered the beginning of the housing bubble. Americans saw that as an opportunity of borrowing money cheaply at low interest rate to buy homes. So some people were blaming the Fed, that the Fed was the one that was responsible for creating the housing bubble. John Taylor, who is a professor of economics at Stanford, actually was the one leading this charge against the Fed, that the low federal funds rate or the low interest rate that the Federal Reserve operated during that time, stimulating housing demand, encouraging the issuance of subprime mortgages, both which led to the rising housing prices, what we're calling the bubble in the first place. But the Federal Reserve short bank, it was Ben Bernanke who was the chair of the Fed, argued that it was Wall Street banks who were supposed to blame on the government because Wall Street banks were the ones who came up with these new financial products that were unregulated by the government. See, so the blames, people are placing blames, left and right. So the debate whether monetary policy, whether the Federal Reserve is to blame, or Congress, or for lack of regulation, or Wall Street, continues up to today. Okay. So what about what happened in other countries? Because this crisis spread and became global, given that with globalization, if America is in trouble, that's going to spread to Europe, to all over the world. So we see the European sovereign debt crisis. Countries like Italy started becoming, Greece went bankrupt. Greece defaulted on its debt in 2008. But other countries that were actually really in debt too were places like Ireland, Portugal, Spain, and Italy. The stresses created by these and related events continue to threaten the viability of the euro as a currency and the eurozone. Okay, so the height of the financial crisis was felt around this time. The stock market crashed, and you saw that already. Interest rates faced by borrowers led to sharp declines in consumer spending and investment. Unemployment in the United States peaked at 10%. In some countries in Europe was a lot worse. The credit spread that I talked about, which is a difference in interest rate between a bond with zero default rates, that's a U.S. Treasury bond, and a corporate bond which has got risk, which is rated BBB, shot up to 6% from around 2%. Okay. So here's some additional governmental intervention and recovery effort. So due to the government and central bank intervention, the Great Recession was far smaller in magnitude than the Great Depression. Great Recession of 2007, because there was a lot of intervention in the marketplace. Okay, so you can read a little bit more during your free time. Some of the programs that the government had to come up with. What about COVID? Could coronavirus pandemic have led to a financial crisis? We know COVID 2020 had the potential to trigger a financial crisis as serious as 2007. So we know that. With the start of the lockdown of the U.S. economy in 2000, the stock market crashed, falling by more than a third. Unemployment skyrocketed, like up to about 22%, 25%. All the factors that potentially led to a financial crisis shown in the first figure came into play when the pandemic became severe in March 2020. We know that. But a combination of Federal Reserve and the United States government policies helped to shore up businesses, after COVID. Okay. So here are some of the responses from Congress to ensure that this crisis never happen again. First of all, I want to define there are two terms here: macroprudential and microprudential supervision. Macroprudential, the first term there, basically the idea that the government is going to put the regulatory measures which can affect the economy at the aggregate level, at the macroeconomic level. So let's say they pass in some regulation, that regulation could affect all banking. But when you're talking about microprudential, that is at a micro level. It could be some regulatory policies that the government may put in place that affect only a subsection of the financial market. Like it might only be like supervision policy or regulatory policy for only credit unions or savings and loan association, but not for the entire financial industry. That's why we call it the distinction between the two. So in 2010, Congress passed, and bill was sponsored by two congressional congressmen, Barney Frank and Christopher Dodd of Connecticut. Barney Frank, so it became known as the Dodd-Frank Wall Street Reform and Consumer Protection Act. They were the ones who sponsored that bill. Okay, so they passed this bill to ensure that this bill was supposed to increase more regulation, protect consumers, regulate banks so that banks never screw up again. And so you want to read a lot about I'm not going to test you on that. You go and read about the detail of how the consumer protection, the annual stress test, resolution authority, systemic risk regulation, the Volcker rule, the derivatives. I'm not going to test you on those. But it was one of the bills that was passed in Congress that helped to provide more regulation to ensure that banks don't screw up again. And then part of the things that is in the Dodd bill, Frank, and that also like has triggered the debate up to today is that the idea about the too big to fail and future regulation, because some people argue that there's several banks in America which have become so big, like we call them the too big to fail, like Bank of America, Citibank, Wells Fargo, Capital One, JP Morgan Chase. Those banks, they're called too big to fail because the idea is that government now has like an appetite. If a bank like a Bank of America was supposed to go in about to fail, the government knows that it's too big. We need to what that you can if Bank of America fail, it can drag the entire economy with it. Then the government always rushes to bail out such banks. So some people are arguing, some politicians and economists are arguing that why we should break up those banks, because they're too big, break up large financial institutions. And all some people argue, no, we should just increase capital requirements. Okay. So you can read part of the Doge Frank, what he says about that, during your free time. Okay. So the last part, I'm just going to discuss this briefly. So whatever I've talked about, you can see even the case studies I'm talking about, the Great Depression, the Great Recession of 2007, 2009, that had their origins in the United States or in advanced economy. So even the sequence of events leading to a financial crisis in an advanced economy like the United States are somewhat different from the sequence of events that lead to a financial crisis in emerging market economies, or you can call also developing countries. So when developing countries are going through a financial crisis, we've seen several crises around the world, like in Mexico, 1994-95 peso crisis, the Argentina peso, debt crisis of 2001, the East Asian crisis of 1997-98, the collapse of the Soviet Union, and others. We had crises almost in every country, in developing country in the 80s and the 90s and early 2000s. When developing countries or emerging market economies are going through a financial crisis, the sequence of events leading to that crisis is somewhat different from the sequence of events that we have seen leading to a financial crisis in an advanced economy like the United States. So let's talk about that. So this part of the chapter is going to apply the asymmetric information theory financial crisis to investigate the cause and frequent deficit crisis in emerging market. Analysis then applied to events surrounding financial crisis that took place in South Korea. We're going to have some case studies in Argentina, and maybe in Mexico. Okay. So let's talk about the sequence of events leading to a financial crisis in emerging markets or developing countries. Path one, which is the initiation of a crisis, they also experience credit boom and credit bust. But we're not going to be discussing issues of innovation, because most of the innovation that happen in the financial industry tend to originate from advanced economy like the United States, like on Wall Street. So that's why you don't see a lot of issues of innovation here. So the main source of financial crisis in developing countries or emerging markets always start from when banks start to screw up having the credit booms. Just, part of it happens here in advanced economy. I discussed that already anyway. But we're not talking about innovation here. We're just talking about credit booms here. So, and then most of the developing countries' financial industries the governments have weak supervision, and there's lack of expertise that lead to lending booms. So they make mistake too and give loans to maybe give credit, bad credit, that sometimes leading to customers not paying back the loans, and the banks are going to suffer. And then the other thing that is very typical of banks in developing countries is this problem, which we call the problem of regional sin. I want to talk about it here. There's a famous concept which we call it the problem of original sin. What do we mean by the problem of original sin? So developing countries banks, or their government usually borrow from foreign banks in advanced economies. Foreign bank in advanced foreign banks, foreign banks / government in advanced economy. But such debt is always denominated in a foreign currency like the US dollars. Okay. So what does that mean? So when Mexico is borrowing money from the United States, or a Mexican bank is borrowing money from a bank in the United States, okay, that debt, that loan is always denominated in US dollars, in a currency that Mexico does not control. Okay. So that means a depreciation in the local currency, or you can say appreciation in the dollar, raises the local currency equivalent of the debt. Local currency equivalent of the debt. Okay. So this leads to more. So this puts the country into more debt. I'm gonna illustrate one here, an example here. And some countries, if it's a country borrowing money, like Mexico borrowing money from the United States, what we call bilateral lending, that is gonna lead to if the Mexican peso loses value at the time when they're supposed to pay back the loan to the United States, that is gonna raise the local currency equivalent, the local peso, the Mexican peso equivalents of the debt. And if Mexico does not have enough money to pay back, sometimes the Mexican government is going to resort to printing money. And we have learned from this class that once you print too much money, that's going to result into inflation, then the economy is going to fall apart. That's what we call the problem of regional state. You know, the United States is very lucky. Even though our debt is $36.5 trillion, when the United States is borrowing money from foreign countries like Japan or China or everywhere, America borrows money but that debt is denominated in US dollars, in the currency which the United States controls. So whether the dollar depreciates or appreciates, you still owe the same amount because you're going to be paying back in the same currency that you borrowed. That favors the US. But when developing countries are borrowing money from the United States, let's say the government of South Africa borrows money from the United States, they don't allow that debt to be denominated in the South African currency, which is a rand. That debt is always denominated in the US dollars. So when the dollar gains value, by the time South Africa is supposed to pay back the United States, that means the South African rand is depreciating. That means the local currency equivalent of the debt in terms of the South African rand has gone up. So that puts even South Africa more into debt. So if they have to pay back that debt, that's going to lead them to sometimes even be forced to print more money, more South African rand. And printing of more rand means the rand is going to lose even more value. That's going to cause inflation. Okay, so I'm going to give you guys a simple example here what I mean by this. And it's not only countries that borrow from another country. Banks can also borrow from foreign banks. Like a Mexican bank can borrow from a foreign bank in the United States. They're all going to suffer the same dilemma like a country, Mexico, as a government borrowing from the United States. So whether it's bilateral lending or multilateral lending, the fate is the same because that debt is always denominated in a currency where the developing country like Mexico does not control. Okay, so let me open a slide here, then talk about give you an example. Okay. So let's just say the problem with regional scene here. Suppose Mexico, if Mexico borrows, it's a simple example. $1,000. We know Mexico is not borrowing 1,000. They're borrowing millions or billions of dollars. But let's just for our purpose. Mexico borrows $1,000 today from the U.S. government. See, the debt is denominated in what? In dollars. And let's say today, when they're borrowing, this was the exchange rate. Let's say $1 was equivalent to 10, let's just pretend, 10 Mexican peso. Okay? So that means Mexico has borrowed what is the peso equivalent of $1,000 if $1 buys you 10 peso? So that means Mexico ideally has borrowed equivalent of 10,000 what? Peso. So let's say tomorrow could mean next year or 2 years or 5 years from now when Mexico has to pay back. Let's say tomorrow's exchange rate, the peso loses value. Let's say $1 tomorrow is buying you 20 peso, twice as much. So first of all, the value of the peso today compared to tomorrow, we say that the peso has depreciated, but the US dollar has appreciated, has gained value again as a Mexican peso because now $1 buys up to 20 pesos. It used to buy only 10. So now think about it. Mexico is supposed to pay this debt back to the US tomorrow with interest. Okay? So the question is, I'm just looking at the principle, and I'm not even looking at the interest. So how much does Mexico need to pay? But what's the local equivalence of this debt now, tomorrow, when Mexico have to pay back? What's the local equivalent of 1,000? What is $1,000 in peso tomorrow? That is, if $1 buys 20 pesos, $1,000 that Mexico need to pay to the United States is now worth 20,000 pesos. See that? So that's what I'm talking about. A depreciation in the currency of the developing country is going to lead to an increase in the local currency equivalence of the debt because Mexico borrowed equivalent of 10,000 pesos, but now they have to pay back twice as much because their currency depreciated again as the US dollar at the time when they're supposed to be making back the payments. So we call it, and this is very problematic for many developing countries and emerging markets. That's what puts them a little bit sometimes more into debt. So if Mexico does not have money at this point in time, they might be forced to print some of these pesos and convert it back to the dollars to pay the US back. But that could bring inflation, economy falls apart. What about if this was a bank in Mexico that borrowed from a US bank in dollars? They're supposed to pay back the equivalent too. So that would put the Mexican bank also in the same fate as their government, borrowing from another government. So we call it, that's what I'm talking about here. I say, where did it? Yeah, I said governments in need of funds sometimes forced to buy where did I put this? Yeah, put it, I think I'll open down here. Okay. So the domestic banks borrow from foreign banks. So that brings in this what I just described, the problem with original sin. And then developing countries tend to operate what they call fixed exchange rates. It gives a sense of lower rates, but maintaining a fixed exchange rate can be very costly. The idea that you're going to fix the value of your currency against the like US dollars or against the euro, sometimes if you don't have enough international currency reserves to back up that fixed exchange rates, it can put the country in a severe problem. Like we saw that in 1994 with Mexico. Mexico tried to fix its exchange rate, but then it started running out of reserves. It could not, they didn't have enough reserve to support that fixed exchange rate regime. That led to what they call capital flight. People started to leave Mexico because they knew their currency was going to collapse anyway. And then in developing country, and one additional problem is that banks play a much more critical role. We saw that in chapter 8 when we talk about the structure of financial, but that we were even actually comparing Germany. But in developing countries like Mexico, like countries in Africa, the capital market is way underdeveloped or non-existent. You don't find, there's no clear stock market or bond market like we have here in the United States, where companies can go and borrow money on the stocks, issue bonds, and can easily raise capital. Developing countries are so heavily dependent on what they call debt financing for their activities. So meaning that most companies in developing countries rely so much on bank loans than they would what? Than they would to issuing common stocks or common what? Corporate bonds. Okay, so if the banks fail in those countries, that means many companies will not have avenues of raising funds because there are no banks that are giving them loans. Or if the few banks that survive, they're going to give them loans at business loans at very high interest rates. They just cannot simply afford that. In America, we have option. If banks were to fail, we still have the stock and the bond market, which are operating. So we have like different avenues of raising capital for our corporations. And then once the problem starts from here now, let's say some banks are borrowing in foreign currency when their currency depreciates. Some banks are giving bad loans. That's gonna go to path B, or path B is gonna be this severe fiscal imbalances. So severe fiscal imbalance is the idea that some government that are facing debt crisis like Argentina in 2001, I'm gonna talk about that little case study. They tend to spend more government money than they have in tax collection. So that's what we're talking about, severe fiscal imbalances. In this, severe fiscal balances basically means, like America is also having trouble with this federal government here. Government spending outweighs tax collections most of the time. So if a developing countries keep spending money that they don't have, and then they keep on accumulating those debts, eventually it's going to catch up with them at some point that they're not going to, debt becomes so big that they're not going to be able to pay back, then they start defaulting. So severe fiscal imbalances, and so governments in need of funds sometimes force banks to buy government bonds. So, and when governments default, that means nobody will want to buy government bonds again. So we've seen in Argentina, when Argentina started defaulting, and most people refused to buy Argentina government bond because the government still needed to raise more revenue by issuing more bonds, issuing new debt. But nobody wanted to buy those bonds. Then the government started to coerce banks in Argentina to buy government bonds, which were less in value. So when the government debt lost value, the banks lost out and their net worth decreased. And then additional factors that affect developing countries, that increase in interest rates from abroad. When interest rates in the United States increase, that's a big problem for developing countries. Those companies in developing countries or banks that are borrowing from America have to borrow at what? Very high interest rates. So servicing the debt that they're borrowing, any borrowed funds from the US become a big problem. Okay, and that also an increase in interest rate in the United States could lead to capital flight. That many investors will find U.S. assets more attractive because if they invest there, they get paid what? High interest rate. It could lead to capital flight from those developing countries in the United States. Investors in developing countries seeking a higher return on their investment would find the U.S. assets more attractive, especially treasury bonds and other types of bonds here, pay them higher interest. So that's going to lead to asset price decline because demand for their assets are going to fall. And then the other thing that developing countries are faced with unstable political systems. Many countries are always fighting civil conflicts. There's always civil wars going on in different countries. So this political instability, it can make even their financial system not work well. And then the stage two, once they have all these problems cropped up, and then it could lead to a currency crisis where country loses all its balance, the value of its currency, like in Mexico in 1994. Because in Mexico, political instability in Mexico, which there was an assassination in 1994 when the leading presidential candidate from the PR party, a major political party in Mexico, his name was Colosio, was assassinated in the middle of a presidential campaign. So such type of events led to people believing that most international investors believe who had invested in Mexico, these foreign companies started leaving Mexico because they knew Mexico was going to be unstable. So once they were leaving Mexico, that led to capital flight and the Mexican peso collapse. Okay. And then banks that had borrowed in foreign currency, they will see their deterioration in what? Banks in Mexico that borrowed, say, from the US, or even the government itself that might have borrowed from the United States, they saw the balance sheet going down with currency crisis. Value of their currency deteriorating or depreciating. So government cannot raise interest rates in a bad economy. Doing so is going to force banks into insolvency. You remember that. Okay. So severe fiscal imbalances sometimes triggers currency crisis too. And I talked about that already because sometimes foreign and domestic investors sell the domestic currency because that's what we call capital flight. When they see that the government is about to default because of severe, but they know that the economy is going to be very unstable, they're going to sell domestic assets and flee the country. Okay. So stage 3 is where we have a full-fledged financial crisis in developing countries. The debt burden in terms of domestic currency increases. So the net worth of whether banks or governments are going to decrease. Then increase in expected and actual inflation reduces what? Firms' cash flow. Banks are more likely to fail. The individuals are less likely to pay off their debt. Debt denominated in foreign currency increases. That's what we talked about, the problem of regional sin. So those are the problems. So when I put this in a diagram similar to what for advanced economies, in a more spiral diagram, so you see the stages of what we talked about in a developing or emerging markets. So you can see that it starts with stage 1, and then goes to stage 2, foreign exchange crisis, where the currency loses value. Then that's going to lead to the economic activity declining, banking crisis, all those kind of stuff. Okay, full-fledged crisis like stage 3 that we described. So just to wrap up here, I just want to talk about a few case studies of the financial crises that have happened around the world in those emerging markets or developing economies. Let's look at first of all, the crisis in South Korea, which happened in 1997, 98. So what triggered the financial crisis in South Korea in 1978, 1997, 98? So there was financial liberalization in South Korea and globalization was mismanaged. What do you mean by financial liberalization? So back in the days, most South Korean banks were controlled by government. Then the government decided to liberalize, privatize their banking system, turn that to the private sector. But to some extent, globalization was mismanaged. The sequencing of liberalization and privatization was not done right. Okay. So that led to perversion of the financial liberalization and globalization process. The chaebols and the South Korean crisis. So who are the chaebols? I guess a lot of you probably might have heard about the chaebols. The chaebols are basically, some countries have like very powerful, connected families who like, I don't know, there's like a cliche of people who own so many assets in a country. So in South Korea, South Korean companies tend to be owned by a few rich, wealthy individuals that are related to each other. Those groupings of people who are very rich, who might be related, we call those chaebols in South Korea. They own so many companies, like the Samsung, for example. It might be just a group of very wealthy South Korean family that owns Samsung. So if you make a country be controlled by chaebols, by group of related members of a family, control most of the wealth, that can lead to crisis because the corruption can be part of that system, and that's exactly what we saw in South Korea. And that the stock market started declining, and failure of firms increased uncertainty, adverse selection of morals problems worsened, and the economy contracted. But that crisis was very brief. It lasted only for a year, and the economy started. But it started with the mismanagement of the financial liberalization or globalization. So the currency crisis, the South Korean currency depreciated, lost almost a lot of its value. and it triggered a full-fledged financial crisis. But then recovery commenced after that, 1998. It was a brief crisis, but it was deep. What about in Argentina? The financial crisis in Argentina was more of a debt crisis. Okay, it did not happen. It was more of it started from a debt crisis that the government of Argentina mismanaged its finances, its fiscal. It was severe fiscal imbalances for a long time where they were spending a lot of money through corruption, and yet there was not enough revenue, tax revenue trickling in. And then that eventually, that caught up with them. That the government of Argentina had to go into default in 2001. Okay? So adverse selection and morals and problems worsened. Bank panic began. People said because banks started to close down because of the government default, interest rates started rising. Argentina, so currency crisis, Argentina peso lost almost all its value. Okay, and that the loss in the value of Argentina peso triggered a full-fledged financial crisis. But recovery soon began in 2002. Okay. So, and I just gave out just two examples of financial crisis in South Korea and Argentina, but almost every country in South America experienced some form of financial crisis, even Brazil, all those countries. In Africa, the debt crisis of the 1980s and 90s was so bad. Okay, we've seen, and then you go to Russia, when the Soviet Union collapsed. So all these are different types of financial crisis. So I cannot talk about all the case studies around the world. Otherwise, I would be talking about almost every country in the world has gone through some kind of financial crisis, like Greece, for example. Iceland went through a serious financial crisis. Okay, the financial crisis and economic contraction of Iceland started in 2008, followed by the script of financial crisis in an emerging market economy. Even though Iceland is a wealthy nation, financial liberalization led to rising stock market values. The stock market was overvalued, and that eventually fell. And people started taking their money out of Iceland, and that triggered a serious recession in Iceland in 2008. The economy collapsed, literally collapsed. Okay. So what are some of the things that we can do to prevent financial crisis in emerging market economies or in developing countries? Because most of the times there are banks in those countries are ones that are mismanaging, like credit, giving a lot of loans. They have weak supervision of banks. We need maybe to beef up prudential regulation and supervision of banks, encourage disclosure and market-based discipline, and limit currency mismatch, sequence financial liberalization with globalization. Okay. So that is the end of this chapter. So mostly the last part is kind of a little boring. It's about these case studies. So make sure you watch this video, and I'm going to be assigning more quizzes and homework assignments, maybe 4 and 4, this week. That begins this Monday, and then we'll continue doing homework assignments. But for the case of your exam too, you need to study the material. Watch this video, material of chapter 6. Chapter 8, there's no chapter 7. We're not doing chapter 7. So it's chapter 6, chapter 8, chapter 9, and chapter 12. So the midterm exam 2 is going to comprise only of 4 chapters, material 4. But there's a lot of material in there. All the video recordings for all those chapters are at Canvas. If you have not been watching the videos, that's a recipe for disaster. You're going to fail if you don't watch the videos and take note and understand the material. So you need to watch the videos that I normally upload at Canvas, use that knowledge to do your assignments. Then when you come to the exam, you're ready to take the test. Okay. Till next time. Bye-bye.